Hello, everybody. Thank you for joining us today. My name is Samantha, and I'm in client services here at the Retirement Group. I moderate these weekly webinars. Thank you so much for being here. Today, we're going to be joined by our advisor, Tyson Mavar, who's going to be speaking to you, Chevron employees, about the important decision when it comes time to retire on whether to take the lump sum or the annuity. Tyson's going to be providing some valuable insights into how interest rates can influence your plans so that you make the best decision when it comes to your financial future. Before I bring Tyson on, I'd like to remind you that although we work very closely with both active and retired members of Chevron, we are not affiliated nor endorsed whatsoever by Chevron. The Retirement Group is a completely independent group of financial advisors, so please do keep that in mind. And with that, I'd like to just introduce you now to our speaker, Tyson Mavar. Hi, Tyson.
Hi, Sam. Thanks, everybody, for joining our webinar series today. My name is Tyson Mavar. I'm one of the Chevron-focused retirement advisors for the Retirement Group here in Texas. And on today's webinar series, we're going to cover not only the Chevron pension plan, the various options that you have on how to take your benefits after you leave the company. We're also going to talk about the importance of interest rates and how those rates affect the lump sum, how the company observes those interest rates, and how to utilize this information to maximize what you walk away from the company with to maximize your probability of success in retirement. For those of you who aren't as familiar with our company, the Retirement Group is an independent financial planning organization that specializes in helping corporate employees, Chevron being one of the companies whose plans we specialize in, helping folks to put together the most successful retirement plan possible in understanding all of the different benefit options you have, and then utilizing your retirement resources, investing your assets to produce the most successful retirement plan possible. We have a whole host of complementary services that we encourage you to take advantage of prior to retirement. Retirement cash flow analysis has been very helpful to a lot of people to understand the tax implications of different decisions, and also picking a great time to retire to maximize your benefits. As well as a variety of other analyses. We have a net unrealized appreciation analysis to help people understand whether or not that's an effective tax strategy for their Chevron stock. We have a Social Security analysis, and we also help people with their 401k asset allocation prior to retirement in an effort to help people prepare for that transition, but also to allow people to get to know us to see if it might be a good fit to work with our firm after you leave the company, should you decide to work with an advisory firm at that point. Take advantage of these if you haven't done so already, and certainly if it's been a while since we've updated your plan, let us know so we can update that again, because many of you have seen, especially this last couple of years, a lot of changes to the interest rates that affect the pension, changes in tax rules that affect retirement accounts. There's constantly changes, and that's why we try to pivot whenever necessary in terms of the optimal plan, so we can be accounting for those changes as they come our way. There's also a QR code on this slide. If you are not following us on LinkedIn yet, I encourage you to do so, as that's where we publish content such as the webinar that we're doing today. Some of it related specifically to the Chevron retirement strategies, and some of it generic to various retirement planning strategies such as estate planning, tax planning, investment planning, and a variety of other relevant information for folks that are approaching their transition from Chevron. Now, as far as the pension goes, the pension is a function of where you have been during your career as a Chevron employee. We have clients that worked for Gulf originally, Texaco, Getty, Unocal, variety of different heritages with the company. And this is going to be relevant in how the company calculates your pension, as well as some of the rules on how you can take your pension. And when we run that cash flow analysis, we'll look at which plan you're on. We'll talk to you about some of the different timing issues, and then also specifically, if you're considering a lump sum on the pension, the interest rate issues that affect your plan specifically. But what's in common with all these plans is that age 65 is what they consider the normal retirement age, and that's relevant for a couple reasons. One is that that's when you'll have to take your pension if you retire prior to age 65. You don't necessarily have to take your pension right away, and we'll talk about some ways today, or some reasons you might consider deferring the election of your pension after your retirement. But if you retire at or beyond age 65, there's going to be an immediate commencement of your pension, which doesn't give you the same flexibility of picking a commencement date as a result of what is happening with interest rates and how they affect your lump sum. Now, there's a variety of different distribution options, but the single life annuity is the default payment option and the option by which all other options are calculated. So let's talk about how these different options work and some of the benefits and potential detriments of these various options. Single life annuity is a guaranteed, and I say guaranteed by the full faith and credit of Chevron, of course, guaranteed lifetime payment for the rest of your life only, for one annuitant, as they call it. This is the largest of the annuity payout options, but when you pass away, those payments stop and there is no death benefit to spouse or other family members. This is a fairly attractive option for folks that maybe don't have beneficiaries, potentially folks that expect a longer than average life, and maybe even folks that have a lower than average risk tolerance. Because as long as Chevron stays in business, they are required to continue paying this amount. So there's a variety of reasons to consider this option, although it is not adjusted for inflation. So one of the risks with taking any of these annuity options is that inflation drives up our cost of living, which is going to drive down the value of these fixed dollars that the company is paying you for the rest of your life. The joint survivor annuity is a fairly popular option for married individuals, although the joint annuitant does not have to be your spouse. It can be another family member or just any non-spouse. And this is where the company is guaranteeing payments for 2 lifetimes. As a result, this payout option, and as it turns out, there's a variety of different joint annuities you can select, but all of them are going to be lower than single life annuity because the life expectancy of 2 individuals, of course, is longer than the life expectancy of 1 individual. And the options that you have, you could take, for instance, a 50% joint survivor, wherein your spouse or your joint annuitant has a reduction of income into the household of 50%. So for instance, if you were receiving $3,000 a month during your lifetime, your joint annuitant would receive $1,500 per month for the rest of their lifetime, assuming that you passed away before them. And you can also take a higher payout to your joint annuitant, for instance, the 100% joint survivor, wherein your payout will be even lower during your lifetime, but where your joint annuitant's payout will be unchanged. They will get 100% of what you were getting during your lifetime. So a lot of flexibility here. The best option is a function of many factors, such as whether or not your spouse or your joint annuitant has a pension of their own or the resources that they have. We had a client who had a special needs family member. I believe it was his daughter that was added as a joint annuitant. Although because the daughter's life expectancy is much longer because she's much younger than the client in this case, the reduction in payout during his lifetime was even larger because, of course, that Chevron is planning on paying or expecting to pay somebody for a longer period of time. So age is a factor in how much they're discounting this joint annuity option. But a decent option, especially for married folks that maybe your spouse doesn't have a pension of their own, or maybe you're concerned about when you pass away or when one of you passes away, one of the Social Security paychecks going away. Something else a lot of people don't realize is if you're a married couple and one of you goes, you're going to switch from filing a joint tax return to a single tax return. So it's likely that your taxes will go up too. So there's some risks when somebody passes away in the family in retirement. And these are issues that we're looking at when we're selecting the best option or likely the best option to take on the pension, as well as how we're dealing with other assets in the retirement plan. The lump sum option been very, very popular, even now that interest rates are higher and the lump sum payouts are lower as a result. This is an option where the company does not have any obligations to you after you retire other than a one-time lump sum payment. And what most people do when they take that lump sum is they roll it over so as not to have any immediate taxes into a qualified retirement account, such as your 401k or an individual retirement account. And there's reasons that you might consider both of those options. As a result, you don't pay immediate taxes, but you pay taxes going forward as you withdraw money from that qualified account, whether it's your 401k or a traditional IRA. And you essentially are responsible for creating your own pension. Within that qualified plan, you can buy, in most cases, any investment you like, whether it's to grow the assets, to produce income, to protect your principal. There's a variety of different attributes and investments that is part of our responsibility to our clients when they entrust us with these assets. And one thing that, for instance, I had a meeting earlier today where somebody's considering the lump sum versus the annuity, and she and her spouse are going to continue to work potentially for another 10 years, meaning that they won't actually need income for quite some time. That could be a consideration to take the lump sum in an effort to defer taxes for a longer period of time, as well as growing those assets until you actually need them, rather than taking the annuity and paying taxes on money that you don't even need and potentially putting yourself in a higher tax bracket. There's a lot of considerations on all these options where we find it's very, very helpful to put everything down on paper, to run that retirement cash flow analysis, and then we can start to back into how your specific situation might change the option that you take because of tax efficiency or risk tolerance, or maybe there's some specific issues to you, health concerns. All of these are taken into consideration when deciding which option is likely to produce the most money during your lifetime to you and your family. Now, the lump sum, the way it's calculated is they're going to take that single life annuity we mentioned earlier, and they're going to project what they would have to give you as a lump sum in order to make you indifferent between taking the two options. So there's two important variables here that they are using to calculate the lump sum. One is your life expectancy. The younger you are when you retire, of course, the longer your life expectancy is, and the more money Chevron has to give you as a lump sum as a result of that longer life expectancy, all other factors held equal. The older you get, the lower your life expectancy, the less the company has to give you as a lump sum. So this is why if you were to retire after age 60, and let's assume interest rates didn't change, you would actually see your lump sum declining the older you get because your life expectancy is getting shorter. The other factor that needs to be known to calculate the lump sum is, of course, interest rates. And this is why when interest rates go up, the lump sum goes down, because the company is figuring you can earn more interest on that lump sum. And in order to make you indifferent between the annuity or the lump sum, they don't have to give you as much money on the lump sum in a higher interest rate environment. So let's talk about how these interest rates play into this decision. And I think it's helpful also to understand when interest rates go up, why the lump sum goes down. It's very similar to when you take out a mortgage for a home. Let's say, for instance, you go to the bank, interest rates are at 4%. It sounds pretty attractive now in this environment where most mortgage rates are north of 7%. But let's say a couple of years ago, you went and you could get a mortgage for 4%, 30-year fixed. The bank, or you tell the bank that you have $1,950 per month in your budget that you can afford to pay for a home. And they tell you with that budget, they're going to lend you $408,500, or at least that's the house you can afford, is a little over $408,000. And let's say you went back a year later and interest rates had gone down to 3%. Well, if your budget had not changed, the amount of house you can afford to buy is higher. Interest rates went down, and that lump sum of what they're going to lend you for the house you're going to buy has gone up. So very similar, we call it a present value calculation in finance. Same thing with your pension. When interest rates go up, your lump sum is going to go down. And the older you get, your life expectancy shortens, your lump sum is also going to go down. And we actually have some real world examples from at least one individual. This was back when interest rates were very attractive in 2020. So let's go through this individual's statistics. So birth date in October of 1960, benefit commencement date of, and this was projected June of 2020. So this individual was not yet 60 yet, and some of you will know, well, they're going to have age penalties on their pension if they take their pension prior to age 60. Not necessarily retiring before age 60, because you could retire and wait to take your pension and see your pension growing because you're aging out of the penalties as you approach age 60. Well, in this example, they were just short of age 60. The commencement date for 59 years old and 7 months. They had just over 31 years of service. They had Social Security PIA, which stands for primary insurance amount, of 2405. That is relevant because it goes into the calculation of both your lump sum and your annuity, what your projected Social Security benefit is going to be. And I will mention, and this is something I want to talk more specifically about as you approach retirement, but sometimes the company gets this wrong, and sometimes it's not a benefit to you. Sometimes they're reducing your pension benefit because they over-projected your Social Security and were offsetting your pension by too big of a number. Well, it turns out you could prove this to the company, and if it benefits you to do so, which will help you identify, you could increase both your lump sum and your annuity payouts. I have an example of one of our clients whose lump sum went up over $31,000 because we recommended he turn in his Social Security statement, and the company was over offsetting his pension because they believed his Social Security benefit was higher than it actually was. So real money here. Another client that they increased, I believe it was about $285 per month. They took the joint 50% survivor annuity. So definitely worth spending, might only take 15, 30 minutes to make this evaluation before you commence your benefit. And you definitely don't want to just turn in your statement without doing the evaluation, because they could also reduce your pension payout if they got it wrong in the opposite direction. So back to our example here. This is back when interest rates, you can see there's 3 of them here. The segment interest rates, which are based on short, intermediate, and long-term corporate bonds. They were a lot lower then than they are now. His highest average earnings was just under $200,000, and this produced a lump sum of $1.525 million and some change. Also had a single life annuity option of $7,357 per month. Now we have another example, and we ran projections to say, well, what happens if you wait? In this case, I believe it was, 5 months? June to November, yes. But what if you wait 5 months? You'll be beyond age 60 at that point, so you won't have any age penalties. However, at that time, we knew that interest rates were going up. We didn't know exactly how much they'd go up during that 5-year period, or if they would go down in that case. But they were going up based on the data that we had based on the look-back period, which we'll talk about in a moment here. And even though the age penalties would go away if he deferred his pension, the higher interest rates produced a lower lump sum. It's $1.508 million. So that's about $17,000 less on the lump sum, even though there's no age penalties in the second scenario. And the other thing I want to mention here is that it's better to get money earlier if you can, because of the opportunity cost of what you could earn on that money. And now with interest rates higher than they were a couple of years ago, it's a higher opportunity cost for leaving money in that pension. So not only would you, in this case, want to consider taking your pension earlier to get more money, you want to get your money sooner so you can invest that money sooner and earn a fairly reasonable rate, even on the lowest risk investments like CDs and money market accounts. All of this needs to be considered in this decision on when to retire, as well as when to commence your pension benefit. And I didn't mention, but on the last scenario, you would have seen that the annuity was bigger if he was to wait. So if they were planning on taking the annuity, that might have been a consideration to wait. But in his case, he was taking the lump sum. So that was what we ended up doing, is electing it earlier, get the money sooner, and get more money out of it. Now, this slide talks about the Chevron blended, those 3 segment rates we looked at. And this is what's happened over the last 2 years. The line in blue is the first segment rate, short-term corporate bonds. They've gone up the most, although the second and third segment rate have gone up a fairly substantial amount as well. And interestingly enough, all 3 rates are very close to one another. In fact, we're actually in a unique environment of what we call an inverted yield curve, where short-term interest rates are higher than long-term rates. That's not very common in money markets, but that is an environment that we're in today. And all 3 of these rates are very close to one another. Essentially, unfortunately, producing lower lump sum payouts. But of course, the silver lining on that is you can take that money and earn more interest than you could have 2 years ago, which is precisely why the payouts are lower than they were 2 years ago. I'll zoom in this one to show, in discussing this look back period that we talked about. This is the most recently available data that we have here in September of 2023. The IRS publishes these interest rates monthly, and it usually takes them about 3 weeks into the month to publish the previous month's interest rates. So we have August, July, and June interest rates. Well, as it turns out, a company has a 3-month look back period where if you were to retire today in September, your earliest benefit commencement date would be October 1st. And all these benefit commencement dates have to be on the 1st of the month. The earliest one being the one directly after you retire. But then you don't have to take it right away, and you might strategically avoid taking it right away in an effort to get more money. But the way the look back period works is that they're going to look back to the 3rd, 4th, and 5th month prior to the month that you commence your benefit. So the data that we have available today allows us to predict what the true blended interest rates will be for November. Because if you were to commence your benefit November 1st, the look back period, remember, is 3, 4, and 5 months prior. So they're not going to look at October or September, but they will look at August, July, and June. So now you could go into your pension model or through the benefits website and run a calculation for November, and that would be fairly accurate because we have the data to do that. And then compare that to an October 1st commencement date, which we also have the data for. That would exclude August, but it would include May, looking at the 3rd, 4th, and 5th month prior. And we can see, is the lump sum going up or down as a result of waiting until November? And we might want to put in an election to commence our benefit for October if we found out that we were losing money by waiting until November. So this is just one example of how this helps to understand these interest rates and why it's important, we believe, to work with a specialist, somebody who understands the implications of these rates on your pension and can help you pick the optimal time, not only to retire from the company, but to take your pension, as the two don't always coincide. There could also be some incentives to leave your pension where it is if you retire prior to age 60 because of the age penalties, like we saw with the previous example. But you're also exposed to the interest rate risk while you leave your pension at the company. So both of these things need to be looked at. And our whole objective here is to just maximize how much money you get out of the pension, and then also get it reinvested as quickly as possible so you're not losing out on a pretty decent rate of interest these days, at least compared to 2 years ago. Now, unfortunately, what we found statistically is that 74% of Americans over the age of 50 do not even have a written plan for their retirement. And as far as we're concerned, this is not acceptable, folks. It's too important to wait till the last minute to put this together. So take advantage of this. There's a number of companies that'll do this for you. Ours happens to be complimentary because we want to build a relationship with you prior to your retirement in hopes that you might consider doing some business with us at retirement. And there's no obligation to do any business with us. We're very confident that going through this exercise with us, at the very least, you'll help us grow our business by referring us to some of your coworkers before you leave the company. So if you'd like to request that analysis or just have some specific questions, we'll open it up for questions here in just a bit. But to get a hold of us, you can email us at info@theretirementgroup.com. You can call us at our home office at 800-900-5867. Or you can also take a picture of this QR code here to get onto mine or one of my colleagues' calendars who understands the Chevron benefits, so we can talk through your retirement strategy. And again, here's that LinkedIn QR code to follow some of the content that we produce, much of it specific to the Chevron retirement strategies. That's all the content that we had today, but we may have some questions. So Sam, I'm going to let you ask any of the questions that came up if we still have some time.
Yeah, we have a few minutes to answer a couple questions, Tyson. Okay, so this first one, how should I use the direction of the rates and the look back to optimize my retirement planning?
You've just got to be very proactive at this. I would recommend looking at this once per month because that's how often the rates change. And in that scenario we looked at earlier, comparing different commencement months, so the upcoming 2 months, and you can see whether you're gaining or losing money as a result of the changes in interest rates. And if you're unfamiliar how to run these projections, call us and we'll walk you through the benefits website. And typically we'll encourage you to, especially if you're not close to retirement, if you don't think you're close to leaving Chevron, run a variety of projections so that you're ready maybe for an offer that could come out. We've seen those come out, it seems like every 3 years for the last decade. Or even more often than that in some cases, or be ready for interest rates to go up so you can be psychologically ready to make a good decision to retire potentially. And we'll give you some suggestions on what to assume interest rates do when we're running those calculations. I almost always encourage people to assume that interest rates go up to see what that does to your lump sum and prepare for having potentially less money than you have in the current interest rate environment. It's very possible interest rates could continue to go up because we still have higher than average inflation that what our central bank would like to have. So let us know how we can help and run those projections with you. And we'll need to do that anyway to run your cash flow analysis.
Thank you. I think I should have read this one first, but I'm reading them in order. What is the look back and how does it work?
Good question. We kind of breezed over it quickly. It's a 3-month period. It essentially gives you a crystal ball of what's going to happen to interest rates and how your pension is going to be affected. So they're not going to use the current interest rates when they retire. When you retire, they're going to use previous month's interest rates in order to give you some time and enough information to make a good decision on the timing of your retirement. So I would say my best way to describe the look back period.
Thank you. Okay, couple more. Can you think of some common mistakes others have made when using the look back to calculate their lump sum?
Yeah, not even being aware of it, I would say, is probably the most common mistake. Most people don't understand how all of this works, but we believe it's critical to. It could mean tens, if not hundreds of $1,000s more or less in your retirement plan. So it's important, especially as you get close to leaving Chevron, to pay attention. And I would argue important to understand well in advance of your retirement, because on average, I probably have 40 clients or more that are retired from Chevron. And it's very rare. I'd say probably less than 5% of them retired on the day that they originally expected to retire on, for a variety of different reasons. So it's important to be diligent and proactive so that you're ready for, like we mentioned earlier, an offer to come your way, or interest rates going up and you need to leave sooner, or some of those other unexpected things that come up, like health issues or family issues, or a job offer somewhere else, or maybe your job changes and you're not thrilled about the new circumstances. This is one of the reasons it's really important to put a plan together well in advance of retirement, so that it's not so stressful when you're transitioning, so that you're not forced to make a decision under duress, and so that you're prepared on how much money you'll actually need so you can make the best possible decision on when to leave the company.
Alrighty, thank you, Tyson. I'm gonna do 2 more. I think we have time for just 2
Okay.
more. Can I defer my pension from Chevron after I retire and wait for the rates to drop in the future?
Yes, with the one exception that we talked about, age 65 is the normal retirement age. You cannot defer past that age. So if you're already 65, that's not going to be an option, but it's something we strongly encourage people to do. Certainly before age 60, because there's still age penalties, but in some cases, even after age 60, if you were 61 when you left the company, but we predicted that interest rates were going down based on what the look back interest rates were telling us. In fact, I did this with one of my clients that she retired, I think it was 59. She wasn't yet 60. So we waited a full year, but then we waited even past her 60th birthday because rates were going down every single month. And as soon as we saw those rates start to switch directions and her pension lump sum was going down, that's when we pulled the trigger on the lump sum and truly maximized what she walked away with on her pension.
Wow. Okay, last one. Given the complex nature of the look back period, how have past projections matched the actual amount of the lump sum retirees receive? It's a little dense.
Yeah, it's a good question. It's impossible to predict the direction of interest rates. So let me first say that. What is possible, though, once these rates are officially announced, they are very reliable in terms of what the company is going to use. In fact, by plan rules, the company has to use those interest rates unless they make a change to the plan rules, which was done, but because of an act of Congress, literally through the Pension Protection Act, where companies started using corporate bond rates rather than what they used to use, which was 30-year treasury rates, or the GAT rate, which is a lower rate and produced higher lump sums. It did take an act of Congress to change that rule, and I don't anticipate that's going to change anytime soon. But I guess the short answer to that question is very reliable once the rates are official. If somebody tells you that they know what direction rates are going, though, I would be very suspicious of that. because it's just not predictable. And we just have to watch on a monthly basis because that's how often the data is made available to us.
Alrighty, Tyson, I believe that's all the questions we had time for today.
Oh, great.
Closing thoughts?
None. I think we covered a lot today. Thank everybody for your time. Everybody have a good, safe rest of your week here, and we hope to talk to you all very soon.
Thank you.